Hello, and welcome to a special combined episode of Williams Mullen's GovCon Perspectives and Employee Benefits Companion podcast. I'm your host, Brydon DeWitt, and today I'll be joined by Carl Grund of Signature Financial Partners. Thank you for participating in today's podcast, Carl.
Yeah, thank you for having me.
Carl, first, can you tell us a little bit about yourself and your background and the services you provide your clients?
I focus on two main areas, those being 401k and executive compensation, specifically for local government contractors.
Well, Carl, our clients are always looking for ways to attract and retain employees, and employee benefits is an important part of that. What can companies do, especially government contractors, to set themselves apart?
Yeah, it's a great question. I think it becomes a real big challenge locally because it's very hard to, one, there's a lack of talent in the marketplace to fill some of these different positions when we look at some of the Intel-oriented companies.
So there's a lot of competition.
A lot of competition, and it's not going to get any easier. Specifically too, when you have Amazon that's going to be coming into the area,
right,
and they're going to be paying high salaries, offering stock options, and given how much they've grown over the years, that's going to make it very, very difficult for some of these companies to compete.
And it's a daunting task for a small, say you have an employer with 100 employees or 50 employees for a small government contractor to compete with the Amazons of the world.
Exactly. How do you do it, right? And that's the constant conversation that I have with a lot of government contractors locally. It's how do we really focus on bringing in some of these key individuals? So, we're really looking at a lot of those project managers, the business development folks, providing additional support within the C-suite of the organization. So we work with a lot of different companies to create strategic plans. So one of the areas every company looks at is going to be health insurance, right? You want to offer strong benefits to all your employees. You also want to have an ancillary benefit program. But one of the areas I tend to find that really drops off would be in the 401k space. A lot of the companies that, when I meet with them initially, it's, hey, we want to offer a safe harbor 401k. Now that can be just a match where you match up to 4%, or you may just give 3% to all employees. And they've been coached that, that's what we need to do.
Right, and I guess a lot of the smaller employers, they have some key employees who are highly compensated, and the allure of a safe harbor is that by making that 3% non-elective contribution or making the safe harbor match, they don't have to worry about the non-discrimination testing that prohibits higher compensated employees from making deferrals that are far out of pace with what the non-high pays are making.
Exactly, and that's really where the advisor and the team the consultant that's working with you really should be focusing on how can we do something a little bit different? How can we take care of these key employees? And for me, the 401k, because we can do some different plan designs to kind of skew the benefits towards that executive group, can be an excellent tool. And I often find it, with a lot of the companies we meet with, they're speaking to other individuals, and right away it jumps to these non-qualified solutions or phantom stock, which can be very, very expensive. So I like to focus again, really on that 401k area and see if there's some ways we can tweak that to make it really attractive for some key folks.
Okay, so let's say you have a client that's interested in starting up a 401k plan. How do you review and evaluate the 401k?
Well, we tend to look at the 401k from a three-pronged approach. So, the first step is doing the compliance review. Do we have an investment policy statement? If this is an existing client, how is the team currently reviewing the vendor? Are we pricing out that plan every year? Department of Labor suggests every 3 years you should do an RFP. I tend to like to review it every year. Right now, there's different 401k vendors that are really trying to buy the market, so to speak, so they're really lowering their pricing every year. So the idea being is if I can take that vendor's pricing and go back to my current vendor, I might be able to get them to drop the price just because they're worried about losing the group.
Yeah, and I think a lot of employers may not realize the fiduciary responsibility that comes along with having a 401k plan. So that's making sure that the investments that you're offering are still prudent and in the best interest of the plan's participants. And ERISA's standard isn't a prudent person on the street, it's a prudent expert. So it often requires, or I think almost all cases requires getting outside help from an investment advisor, an expert on investments. And then also you have to monitor your service providers. And I agree with you. I think the more frequently that you can do an RFP and see if the fees you're receiving are at market, or the fees you have to pay are at market is a really good idea from an ERISA fiduciary compliance standpoint.
And one big recommendation, too, I would have for a lot of these government contractors is create an investment committee. So that way you have a group of individuals that are overseeing the plan, overseeing the investments, overseeing the vendor's pricing. That way, each year you can certainly review this. Department of Labor suggests you should be reviewing your target date funds every year because on average, 80 to 90% of the funds in the plan are going to be skewed towards a target date. So I think that's a very big area. One of the other two areas we look at are going to be reviewing your education for the plan. So I like to have an education plan statement. So that way you have a process for educating the employees. So that way at the executive level we can say, hey, here's what we're going to do for the employees as a whole, whether it be doing annual enrollment meeting or quarterly education meetings. One of the other things too I like to focus on is how we're going to take care of that group that's 50 years older and above. The big challenge is most of those individuals are going to be your BD people, your project managers, your C-suites, ones that are really driving the growth of the business as a whole. So what are we going to do outside the box to take care of them?
Yeah, and I think education is really important because it's employees know they want to have health insurance, right? As you said, a lot of employers, they think benefits, you're going to think health insurance. So we have to educate our clients that they need to offer a 401k plan, but then even the bigger task is to educate employees, to show them the importance of starting to save as early as they can in their careers, because the money is a lot more valuable that you save at 25 than you're saving at 55. So the education and getting employees enrolled in the plan is really key. Okay, so Carl, can you tell us about some of the plan design considerations that you discuss with your clients?
Yeah, and as we were discussing there, that's, I think, to me, the most important thing, because that's an area where we can really target key employees. There's two ways plans are designed. They're either designed as a bundled plan, which means the record keeper, essentially where you go to the website, and the administrator are the same company. And then there's unbundled plans, where you have an outside third-party administrator. That individual's job is to do the plan design for the group, as well as file 5500s and distribute loans, etc. When I prefer to look to the unbundled solution when we're dealing with companies under 100 employees. The reason is we can go in there when we're utilizing profit sharing to target key people. So one of the ideas is you may say to me, hey, Carl, I have 5 or 10 employees that I need to take care of. So our job will be to take those select individuals and try to take care of them with the additional benefits, and then we'll come back to you with an overall analysis to show you what that actually may cost, because you do have to take care of some non-highly compensated employees. Sometimes companies are told that you have to take care of everybody, and that's not necessarily the case. You may be able to target specific non-highly compensated, by definition that's under $120,000 in income last year. With this group, maybe you pick, if you want to lower the overall cost, you might pick some of the lower paid employees that are a little bit younger. So when you give them these contributions, because they're younger, it'll be worth more because they have a longer time horizon of those assets growing.
That's right, and it's important to note that you don't have free reign with a 401k plan to structure it however you want. These are tax qualified plans under Section 401A of the Code, and they have to pass non-discrimination testing. There are rules in the Internal Revenue Code that prohibit these plans from discriminating in favor of highly compensated employees. The plans have to pass a coverage test to ensure that the group that participates in the plan is not skewed toward highly compensated employees. But as you're saying, Carl, if you can structure your plan to satisfy that test, it doesn't necessarily mean that every single employee has to be covered. You just have to make sure that you pass those tests when you're dealing with a qualified plan as opposed to a non-qualified plan.
Exactly, and to that point, that's really where you have your partnerships to go in there and do the administration, do the plan design, do the review, so you know what those costs are, and if you can provide some skewing towards that highly compensated group.
So, Carl, when do you think is the ideal time to start looking at these strategies?
Well, I think right away. I mean, to be competitive in the government contracting space, you're going to have to offer strong benefits. And as we mentioned before, 401k is an integral part of that. But when you're smaller, that provides the greatest opportunity for the executives to put away the most money, as well as for the owners. So, for example, if we talk about the Intel community, where you may have a company with 20 employees, but very high revenue. And for the owner, that's very high tax burden. Well, one of the things we can look at while you're smaller, and maybe if you're only adding a couple employees per year, is a cash balance plan. That might allow the business owner to put away, which is a form of defined benefit plan, it might allow the owner to put away $100,000 to $200,000 away per year, which will really help to guide them towards their own retirement, irrespective of whether they're able to successfully exit the business. As you grow larger, you can't really do cash balance plans because the cost is so prohibitive. And also when we talk about some of the profit sharing, as you mentioned, you do have to give to some of the non-highly compensated, so it can be very, very expensive. So really when you're under that 50, I look to a number of different strategies to really help the owner. As you start to grow, in that 50 to 100, it's really how can we help the owner and executive group. But then as you really cross over that 100, 150 mark, we're really looking at strategies to incorporate non-qualified executive compensation or deferred compensation strategies, or looking at phantom stock or stock appreciation rights, where because we can have the flexibility to not have to follow typical ERISA rules within the 401k, and you can basically create your own vesting and give those employees, frankly, whatever you want from a contribution standpoint. So you have a lot more flexibility with these type of strategies.
So, Carl, in addition to a 401k plan, are there other types of retirement savings vehicles that you've discussed with your clients?
Yeah, that would be on the non-qualified executive compensation front. So we're looking at phantom stock appreciation rights. We do that obviously in partnership with law firms because they're going to be the one designing it, as well as creating non-qualified deferred compensation plans. These plans are really key because you can go in there and pick and choose again who you want to take care of, and you don't have to follow the same rules that you have to abide by when having a 401k. So you have the full control over the vesting schedule, as well as frankly how much you want to provide to them.
And it's really important for employers to understand that when you're establishing these non-qualified arrangements, that there are some very complicated regulations under Section 409A of the Internal Revenue Code that if you fail to comply with those rules, it can have really significant adverse tax impacts for your employees. So as you're thinking about non-qualified strategies, it's really important to get advice on structuring those plans and documenting them so that they comply with Code Section 409A.
Yeah, 100%.
So, Carl, thank you so much for being here on our special edition podcast, GovCon Perspectives and Benefits Companion podcast. That'll wrap up our discussion for today. If you have any questions or suggestions for future episodes, please feel free to contact me. You can also visit our website at williamsmullen.com. There you can find out more about our government contracts and employee benefits teams, as well as past episodes of our podcasts and legal alerts. Be sure to subscribe to this podcast to be notified when our next episode posts.